Good morning, everyone. So I think let's start, and then the rest of the students can join once they're logged in. So today we are continuing with Learning Unit 4, so the financial statements of sole traders. In the previous session, we started discussing this. So in this session, we are going to work through a few questions to show you how to actually do the set of financials if you get this in a test or an exam. So how to actually prepare the set of financials and the notes required. Okay, so just to recap what the learning outcomes are, you need to be able to complete year-end adjustments. So that is the journal entries. Need to prepare a post-adjustment trial balance. So that would be making any amendments for any changes to your trial balance to update it. And then based on their post-adjustment trial balance, then go prepare your statement of financial position. That is where your assets, liabilities, and owner's equity is disclosed. Prepare a statement of profit and loss and other comprehensive income. For both inventory methods, that is where your income and expenses will be disclosed. And then a statement of changes in equity, that's where your owner's equity is. So that's basically your movement in your capital from one year to the next, and then prepare the relevant notes to the financial statement. So based on the financials, the three statements that you have to prepare, you will be required to do additional note disclosure to then expand on how that amount was calculated. Now, let's quickly recap just to refresh your memories what we talked about. So we said year-end adjustments is there to help you work out the performance of a business in your statement of profit and loss, whereas your financial position at that specific point in time, which is your owner's equity. Now, to ensure that those financials are accurate and more realistic, that is why we do the year-end adjustments. That is what we call accounting entries. So it's not physical payments or cash flow that happens. It is an entry that is purely done from an accounting point of view to align the income and expenses to the correct periods. And examples of those are, for example, your depreciation expense, which we covered in Learning Unit 3. Accruals is expenses or income that we should have paid or should have earned already but haven't physically received. We then account for it, and we haven't received the invoice to capture it as such. So then we accrue for it, and credit losses is any amounts that we know, okay, we're never going to see that money in the future, I need to write it off. So that is based on additional information. Now, the main year-end adjustments that you guys will see specifically for financial statements are the following four. So you've got your prepaid expenses, that is expenses that we paid in advance, and that will be disclosed as an asset in your statement of financial position. Then you've got your accrued expense, that is expense that you've incurred. So it's something I need to pay, but I haven't actually paid it yet. So I will show that as a liability in my financial statements. Then accrued income is income that I've earned, but I haven't physically received it. That would be an asset in my books. And income received in advance is income I've received, but I haven't delivered the service or the goods as yet. So for that reason, I would create a liability for in case I need to repay it. Now, what we're going to do in this session is we're going to start with question 4.3 in your textbooks. You will find the question. Let me just page the textbook and I'll tell you which page it is on. Okay, so question 4.3 is on page 118 in your textbooks and 119. I'm going to put up the question here on the screen. Okay, so what we have to do for this question, they have asked us to work out the post-adjustment trial balance. So what they have given here on the left-hand side is the pre-adjustment trial balance. So that is the trial balance before we do any year-end adjustments. So in the first semester, we did this post-adjustment trial balance. So what we first have to do is we create a column for the pre-adjustment amounts like that. And then the post adjustment we would add any amendments based on the additional information to these amounts to get to the post adjustment. So that is the new balances after taking into consideration the adjustments. Then based on that post adjustment trial balance, we will then go and prepare the statement of financial position, statement of profit and loss and other comprehensive income, statement of changes in equity, and then we would also do the notes to the financial statements. Okay, so we're first going to start with the post adjustment trial balance, and then from there on we'll move to how do you actually do the statements, how do you document the statements, because that is what you will be tested on. Now, what is important, you can ignore that in this scenario. Okay, so let's quickly see what additional information they've given to you. So it's cut off a little bit, but you can just follow the most important information is reflected on here. So they tell you the adjustments at year end according to our physical stock take. So our physical stock take here was on the 31st of August, and our balances are actually 21,000 for trading inventory, postage and stationery is 750. Now the postage and stationery we know is consumable stores, which we would have to account for because we generally not have disclosed it. So if we go look here on the left hand side, we can see our trading inventory at the moment is shown as 21,370. So that should actually be 21,000. And if we look at that, we do not have any postage or storage shown as an asset. So we would have to create that consumable stores amount as well. Then if we look at depreciation must be written off at 25% per annum using the reducing balance method. So who can tell me if they say reducing balance method, how do we calculate the depreciation again? What amount do I use? You can just type your answer in the chat function. Okay, so let me repeat the question. Depreciation, if we say it is 25% based on the reducing balance method, how do I calculate it? What amount do I use? Okay, guys, I'm repeating the question. If we calculate depreciation on the reducing balance method, what value do I use? Okay, so Donovan says the amount at the end of each year. Okay, Donovan, you need to specify what amount. Okay, so Pamela, thank you for elaborating. So it is the carrying amount. So we take the carrying amount that is included in here. Now, because of the fact that they tell you depreciation must be written off, you know these balances are actually the opening balances, so we have not adjusted them as yet. So we use the carrying amount at the beginning of the year to work it out. They told you no vehicles were bought or sold, so we know that the cost amount did not change. Otherwise, you would have to take out that amount and do the depreciation for it separately. Then the next information they tell you, the following adjustments must be made according to the accrual concept. So we've got salaries and wages that are payable of 8,000. We've got a telephone that is prepaid for September of 1,800. We've got rent received in advance, okay, of 2,000, and we've got accrued interest on fixed deposit of 210,000. So these are the additional adjustments, year-end adjustments, which we will have to account for. And then they said create an allowance for credit losses of 695 Rand and 50 cents. Okay, so these are the adjustments we need to do. Okay, so for this question, I've already done the pre-adjustment trial balance in Excel. So I'm just going to share that with you guys. Okay, so the first thing with your pre-adjustment trial balance is normally you have to check that the debit and the credit side is exactly the same. Then you know there isn't any errors. That also needs to be accounted for. Now, if we go back to the PDF, so the question, so if we look at the first thing, we said the physical stock take for trading inventory is 21,000. Now that means we need to reduce this balance on here, needs to be reduced by 370,000 to reflect the correct inventory on hand. Okay. And then the other side would generally go to the cost of sales to adjust that amount. So if we go inventory, you would, okay, if you just find inventory. So we want to reduce the inventory. So we would credit inventory with a 370,000. But then because of the fact that it's additional expense, we would then debit the cost of sales and increase the cost of sales, because of the fact that the inventory amount was incorrect. So we've debited and credited an amount, which means we balance again. Then if we go back to the second one, we said postage and storage needs to be accounted for. Now we do not have a consumable stores account based on the statement of financial position, so we need to add it onto that and then reduce the postage and stationery amount to reduce the liability. So what I did here is I added an account which is consumables on hand for the postage and storage, which we then debit with the 750. But because we have that as an asset, I need to go reduce my postage and storage expense for the year with the 750, because I will use it in the following year and then have to account for it in the correct period. So then I credit the postage and storage with the 750. Then the next item we have depreciation must be written off on vehicles at 25% per annum using the reducing balance method. Now the carrying amount is made up of the cost and the accumulated depreciation. So our carrying amount is the 240K, 240,000 less the 60K, which means our carrying amount at that stage is 180,000. Okay, so that's our carrying amount, and we will apply the 25% on that to give us a depreciation amount of 45,000. Okay, now when I account for the depreciation, I need to create an expense account, which is depreciation, and I then have to increase the accumulated depreciation with that amount. So the first step is I increase the accumulated depreciation, which is a negative asset, on the credit side with the amount calculated, and depreciation here at the bottom, I debit it with the 45,000 that we've calculated, because that is the expense that we've incurred. Okay, so you can do the calculation either here on the left hand side or at the bottom, depending on what the format of the test looks like, to assist you with documenting that. Now the next thing we have to do is we have to account for the adjustments based on the accrual concept. So the first one is wages and salaries. We've actually incurred it, but we haven't paid it. So now I have to create a liability in my books of 8,000 Rand to show that I still have to pay it going forward, and then increase the related expense. So let's start with, we increase the expense. expenses is a debit balance, so to increase it, we're going to debit it with 8,000 Rand. Now, because of the fact that we do not have, you won't see a salaries and wages account here at the top, we will include it as accrued expense of 8,000 Rand because of the fact that we've accrued it, or we're supposed to pay it, but we haven't actually paid it as yet, and we haven't captured it, so we just accruing for that amount. Then the next one is we prepaid your telephone for September. So we've paid for an expense. So in the telephone account, we've got an amount that is 1,800 to match. So we need to take that out of the telephone expense account and put it into a prepayment account. And then in the following month, we will reverse it. Okay, so if we prepaid something, it is seen as an asset, because if we do not use the service, we will be refunded. So we debit the prepaid expenses, and then we credit the telephone account to reduce that amount with the expense that relates to the following financial period. And then the next thing is rent received in advance. So we've received rent for a next period, so we need to take it out of our income for this year, and then we have to then deduct it or put it in rent received in advance, which is a liability account. Okay, so income received in advance is a liability account, so we credit it with 2,000, and the rent income that we've received, which is a credit balance of 26,000, includes an amount of 2,000 which relates to the following period, so we reduce that amount with the 2,000 Rand. And then we've got interest on a fixed deposit that we've earned, but the bank hasn't physically paid it out, so we have to accrue for that income in our financial records for 210 Rand. So we've got accrued income, which is an asset for us, of 210 Rand, and then our interest on fixed deposits, we credit with the 210 Rand. Then the last entry we have is the allowance for credit losses, which we need to account for 695 Rand and 50 cents. Okay, so allowance for credit losses is an expense account, so we debit that and then we credit the provision for that as well. So the allowance for credit losses, the provision would be a credit, which is the opposite as the debtors account, and then we create an expense, which is the allowance for credit losses adjustment for the same amount. Then if you get this in a test, you need to add up the totals. You get marks for showing the totals of the adjustments. Your debit side and your credit side should be the same, otherwise you made a mistake here at the top. Then the next step you have to do in a test is now complete the post-adjustment trial balance column. Now how we calculate that is we take the pre-adjustment trial balance and we add the adjustments. But now remember, you will either have a debit or a credit balance, whichever side is the bigger one. You will not have a debit and a credit amount in here. So if we look at the first one, capital as a credit balance, there were no adjustments, so we will have a credit balance again for capital. Same for drawings, land and vehicles, there were no adjustment for those, so those would remain debit balances in your post-adjustment trial balance. Now if we look at accumulated depreciation, both entries were on the credit side, so we would just add the 60,000 and the 45,000 to give us the 105,000. Then fixed deposit, there were no changes, so we just carry that amount over for 42,850. Now trading inventory, we had a debit balance of 21,370, and then we've got a credit amount of 370. So what happens now is we are actually reducing this balance, so we only show the net effect of 21, which is the biggest side of the two, which is the debit side. Okay, so this is an example where there's entries both on the debit and the credit side, and you need to see what side is the bigger one and then show the net effect in that column. Then petty cash, bank, debtors control, mortgage loans, those were all the same. So you would just transfer those amounts to the same side in your post-adjustment trial balance. Then the other adjustments, because they did not have any opening balances, you would then just transfer this amount into your new balances, whether it was a debit or credit, and then update that column. So that is your statement of financial position. And then you would apply the same principle for your nominal section. And the last step is you need to show the totals as you get points for that as well. Okay, now that is how you do the post-adjustment trial balance. And then it would look something like this. Okay, do you guys have any questions on how to get to the post-adjustment trial balance? I'm just going to repeat the question. Do you guys have any questions on how we got to the post-adjustment trial balance? You can just put an emoji or comment in the chat function to let me know that you are okay with this discussion so far and how to get to the post-adjustment trial balance. Bonnie, I will upload the slides and whatever we discuss in class today, I'll put it on VC Learn after the class for you. Any other questions? Okay, so then the next step or the next question they've asked you. So what would happen in a test because of the fact that we have very limited time in a test? They can either ask you the post-adjustment trial balance or they can do what they did in this question, give you the adjustments like this, but then just ask you to do the statement of financial position or statement of profit and loss. And then you need to go adjust the specific line items with these adjustments, similar to what we've done in this column here. Okay, so you would skip this step and just do the disclosure straight from there. Now you need the post-adjustment trial balance, so the post-adjusted values, to do the set of financial statements. Now let's see, we have to do the statement of financial position. Now, for this type of question, they will give you a framework, but you will need to study this, unfortunately, and know what the frameworks would look like. So let me quickly just see where they give you a good example of the frameworks so that you have that close by. So if you go to okay, if you look at page 95, there's a good example of what your statement of profit or loss and other comprehensive income would look like, and page 96 gives you an indication of what your statement of financial position and the note disclosure would look like. Now, if you use that as guidance as we go through this, this will assist you. Okay. So the first thing they ask us to do is the statement of financial position. Now, to do a statement of financial position, you have to go and document it like this. So at the top, let me just make it a bit bigger so you guys can see it properly. Okay, so at the top, you would indicate what statement are we busy with. So you state there, it's the statement of financial position. You state for who it is. So of Muscadel Traders, so that's the company name, and you indicate for what year it is. Okay, now for your purposes, we're only doing 1 year at this moment, but in second year or further on, you would do this disclosure for 2 years, and we call that comparatives. Okay, but for your purposes, you only have to do 1 year. You don't have to do the 2 years. So what you then do is you go document assets, then you do a subcategory non-current asset, a subcategory current assets. Now these items underneath that would generally be blank based on until you know what your question is and what your trial balance looks like. And then you have to show the total assets, which is the sum of the non-current assets and the current assets. Then you've got equity and liabilities. So the first item would be owner's equity. Then you've got your non-current liabilities, which you would then show what makes up the non-current liabilities, and then you would have current liabilities and then indicate what makes up the current liability category, and then your total equity and liabilities would be the owner's equity, non-current liabilities, and current liabilities totals that you would add together. Now these sub amounts you would determine based on the information on your trial balance. Now this is where it's important for you to know exactly what account goes where. So is it an asset account? Is it a liability account? Is it an owner's equity account? Now if you don't know that information, you need to refer back to the first semester information, Learning Unit 2, where they gave you a page that showed you all the categories and the different accounts that are listed underneath it. Or as you do the questions, you would actually learn what account falls in where. So in this scenario, you would then go through here and you would say, okay, capital would be owner's equity, drawings would fall under owner's equity, land and buildings is an asset, vehicles is an asset, accumulated depreciation is a negative asset account, fixed deposit is an asset account, trading inventory is an asset account, petty cash is an asset account, bank is a asset account, debtors control is an asset account, creditors controls your liabilities, mortgage loan is a liability, it's generally a non-current one because it's long-term, consumable stores is an asset, accrued expense is a liability, a prepaid expense is an asset, income received in advance is a liability, accrued income is an asset, and allowance for credit losses is a decrease of an asset. So what I did, okay, I've indicated here where it goes in my statement of financial position, but for your purposes first, I would say whether it's owner's equity, whether it is asset or liability for your initial start. I've already indicated where it goes for note disclosure purposes. Okay, so if we start with property, plant, and equipment, this is all of your assets that you have to do. Now for property, plant, and equipment, because it is made up generally of multiple assets, you would have to do a note disclosure for that. So you would generally go do the note first and then go enter the amount in here. So you would generally align this with a note. Now to make it easier, we're going to do the note and then we'll populate the amount there. You could have also just added the amount straight from your trial balance and you would have gotten to exactly the same amount. So if I go to the note disclosure for property, plant, and equipment, you have to go split it between land and buildings, which you have there, and then your vehicles. Okay, so land and buildings are vehicles, and then you work out the total. Now for that note disclosure, we start with the carrying amount at the beginning of the year, which is the cost less the accumulated depreciation. Then we show any movements during the year. So that relates to any additions, any disposals, and depreciation. And then we update the carrying amount at the end of the year. Now, if we take the information that was in the pre-adjustment trial balance, our land and buildings cost is 550,000, our vehicles was 240,000, and the accumulated depreciation for vehicles was 60,000. So in the note disclosure, I then go show the cost for land and buildings is 550. We did not have accumulated depreciation for it, so it's 0. Vehicles was 240 and accumulated depreciation is 60,000, show it as a negative. Then the carrying amount is the cost less the accumulated depreciation gives me the carrying value at the beginning of the year. Okay, and then the total column is just adding the two left columns together to get to the total amount. Now, based on the information, we know there were no additions, there were no disposals, so these amounts are 0. We did not have any information for depreciation of land and buildings because we generally don't depreciate them, but we did depreciate the vehicles amount. Now, if you go back to this, the depreciation amount for the vehicles was the 45,000, so we captured the 45,000 here, and then we add the total and we add the total column to give us the movement for the vehicles. Now, to get to the carrying amount here at the bottom, for the land and buildings, it's pretty straightforward. There wasn't any changes, so you just carry those amounts exactly the same as at the top. Now, for vehicles, the cost remained the same. We didn't have any additions, so the cost is the 240. We did, however, have additional depreciation, so our accumulated depreciation is the 60,000 plus the 45,000 gives you 105,000 is our new accumulated depreciation, and then our updated carrying amount is 135, which is the 240 less the 105. Now, how do I actually test if I did this correctly? I take the 180 here, less the 45 total there, and you should get 135 as well. Then you know you've done it correctly, and then I just add the land and buildings column to the vehicles column to get to an amount of 685. Now this amount, the carrying amount, just going to highlight the screen, is what I then go and disclose here at the top, is the 685. So I show the carrying amount under the non-current assets. Now, why is PPE non-current assets? Because I will use it for a period more than 12 months. Okay, so that's the first one. Then financial assets is generally your investments. Now let's quickly see what type of information we have here. We've got fixed deposits. Now normally fixed deposits are for a period of more than 12 months. If it's for a shorter period of time, they need to indicate this for you. So for that, we would also generally do a note disclosure, and then we would include that amount in there. Now, let's quickly do the note while we're busy with that. So in this case, we only had one fixed deposit. Normally, we would have multiple in here, and then that total amount would agree to what's in the financial statements here at the top. Okay. Then we look at current assets. Now, inventories generally made up of multiple accounts. In this scenario, it has 2 accounts. So you would first do the note disclosure before you do the amount. And based on the information provided, we would have trading inventory in there, and then the consumable stores on hand would also fall under inventory. So if we look at the note disclosure first, we've got trading inventory, you show the balance, and then consumable stores on hand balance. So your new value that you have for inventory would be the 21,750, and that should agree to the 21,750 disclosed at the top. Now, for non-current, you have to add them all together and show the non-current amount separately, the total, and we'll do the same for the current as well. Now, if we go back to the trial balance, so we've got the land and buildings, the vehicles, accumulated depreciation, we've done the fixed deposit, we've done trading inventory. Now we've got petty cash and bank, which is seen as cash and cash equivalent. So it is any cash or similar type of cash instrument would be added together. But in this scenario, you will see that the bank is actually negative. So normally for disclosure purposes, if we've got a negative bank balance, we would show it as a bank overdraft under the liability side rather than cash and cash equivalent. So if we go to cash and cash equivalents, you would have the note, but in this scenario, it would only be the petty cash because our bank amount is negative. So if we just look at the note disclosure, you would just show what the cash and cash equivalent amount is made up of, and then disclose that at the top. Now I said because the bank amount is a negative bank balance, you would show the bank overdraft amount as a current liability because we've actually used some of the bank's money that we did not have available. Then we've got debtors control. Now debtors control as well as accrued income, those would be seen as trade and other receivables for disclosure purposes. So if we go to trade and other receivables, we would have done a note for that as well. So let's go to trade and other receivables note first. So we've got our trade debtors. You get that amount from your trial balance, which is the 13,910. Then we deduct any allowance for credit losses. So that is the amount that we adjusted, which is this account here, allowance for credit losses. We take it off to show the net trade debtors that we expect to receive in the future. And then we add accrued income. So that's interest we've earned but they have not paid. We add that adjustment as well. And then prepaid expenses, because we've already paid it, and if we don't get the service, we would receive the money back. We also show it as a trade and other receivable, and then we add that amount as a total. And that 15,000 is then disclosed here at the top as 15,000. Okay, now because I've used the 50 cents, let me just do this. Because there's 50 cents, that is where the 50 cents come from. Okay, so that is trade and other receivables. Now we finished the current assets, so if you add all of them together, you get a balance of 37,974 Rand and 50 cents. And then we add that to your non-current assets to get your total assets balance, which is 76,824 Rand and 50 cents. Now this amount should equal to what your total liabilities and equity is once we've completed the scenario down here. Now owner's equity, we know owner's equity is made up of capital and drawings account, and then it is generally the profit and loss based on your nominal accounts. So how you would calculate this, let's see if I've done, okay, I didn't show the calculation. You would also do the calculation for this by using this statement of owner's equity. Oh, I didn't do that account. Okay, so let's quickly do owner's equity. How did I work it out? So I took the capital amount of 46,469,770 and the 8,000. Okay, so I took that. Drawings is deducted from that, which is the 8,000. In the profit and loss amount, I will work it out based on statement of profit and loss here. So I could just take it from here, or if you don't have all of that information, I would take the bottom information here to add it together. So if we quickly do here equals the sum of all my income, so all my income for the year, okay, so that's the income, and the total expenses for the year is this. Okay, so I take the capital amount, I deduct the drawings. Then I add the income, which we worked out as 1,646,130, and I deduct the expenses, which is 735,605,50 to work out the owner equity amount, which then works out, let me just make this a negative here. And if I sum all of that together, you get to the same amount. Okay, so that's how I got to that 372. Okay, so that's the owner's equity. That amount would also agree to the statements of owner's equity. Then the non-current liabilities we said is the long-term borrowing. So if we look at this list here, we've only got one, which is the mortgage loan of 372,000. So we show 372,000 and we show note disclosure. Now, normally the note disclosure would only be for items that have multiple amounts in them, but for your purposes, you have to do a note for everything at the moment in these questions. So if we go to note 8, we would include the mortgage loan information and then total it to show how the total long-term borrowings were calculated. Because we don't have any other non-current items, we would just add that together, and that is the total. Then our current liabilities is trade and other payables, so that is your creditors control and any other type of liability of a similar nature. Now this we would do a note for. So if we go to note, we had our trade creditors amount on here that we've worked out. Let me just find it. Creditors control is 7070, and then we will use the accrued expenses of 8,000 Rand that we need to pay, and then let's see if there's another one, income received in advance of 2,000, which is also trade payable if we need to repay it. So if we add all of those items together, our trade and other payables is 17,070 Rand, and we would then add it in here. And then we would sum that all together to get the total current liabilities. And then if we add the owner's equity, non-current liabilities, and the current liabilities, we get to 76,824. And that is exactly the same as the total assets. So we know that we have captured all the transactions and the debits and credits balance. Okay, so before we move on to the statement of profit and loss, do you guys have any questions on the statement of financial position and how we get to the disclosure thereof? Okay, so do you have any questions based on what I've discussed on how to disclose the statement of financial position? Can you just indicate in the chat function if you're okay with this or if there's anything you're wondering about? Okay, so Donovan says he's okay. What about the rest of you guys? Are the rest of you okay with statement of financial position? I know it's a lot of information. Is there anything that you are wondering about? Okay, Nakantla, you asked, why do we include the income less the expenses, on the liabilities? Okay, let's quickly see. So you are asking, it's probably the trade and other. Okay, so let's quickly look at the trade and other payables again. So trade and other payables, remember accrued expense. So that's the liability we're creating based on the wages and salaries that we need to pay. Okay, so we've actually incurred, people already worked during that month and they have actually provided a service, so we need to record the expense in our accounting records. But because of the fact that we have not captured those amounts in the journals as yet, we then document it as an adjusting journal. Now, for every entry we do in a journal, there needs to be a debit and a credit amount. Now, to increase the wage and salary expense to reflect what we have actually, what our salaries and wages were actually for the year, we need to create the liability to show that we haven't actually physically paid it as yet. And this is what this accrued expense is. That is the liability of what we still have to owe. Now, the reason I put here wages and salaries in brackets is just to show which adjusting entry that related to. Okay? And then the income received in advance for rent income. So our tenant have already given us the money for the rent for the following month. He has not physically stayed in that property as yet for that month. So if he decides to move out before then, we are technically liable to repay him that amount that he's already paid because we haven't provided a service as yet. And this is also a liability for that reason. And then I just showed what type of income related to that category. Okay, so these two come from our adjusting entries. Is that what your question was, or were you actually referring to something else? Did I answer your question? Okay. Okay, so guys, what I think we're going to do is let's take a 15-minute break, and then we will continue with the rest of the question in the following session, and then depending on how much time we have left, we will then start with question 4.4. Okay, so if you guys can be back at 11, I'll see you guys then.